Investors have recently been on edge after the markets suffered several crashes in the past few months. Trillions of dollars have been lost, so where did it all go wrong? Join us in today's video as we hear an analysis of consumer sentiment from billionaire Chamath Palihapitiya. Stick around to the end of the video as this analysis may aid you in your investing decisions.
You take a big step back to the day before the lockdowns started. We had a normal functioning economy that was growing by, call it, 2% a year. And the minute that we enforced these lockdowns, I actually think what we did was we started a supply-side recession. It's what Zach said earlier. So what does that mean? Let's just say you're a factory and you make wheels. Okay, just make something really simple. You were growing at 2% a year. Everything seemed hunky-dory. You had employees. It was fine. You used to sell your products, make 10, 15% profits. Everything was fine. And then the day after, the government said, you need to shut your factory down because we can't have people spending too much time close together because we need to get a handle on this pandemic. Okay, so you shut it down. And then for the next 12 or 18 months, what happens? That stuff sits idle. These people that used to work for you get $2.5 trillion put into their bank accounts. They spend their time doing other things. And then all of a sudden people say, okay, it's time to start the factory up again. People want to buy wheels. And now all of a sudden you find that because everything all around the world was shut down, there's no rubber to make the wheels. There's no steel to make the axle. There's no people to put them all together. And so what happens? Well, prices go up because, again, you gave everybody else $2.5 trillion. So they're like, well, I used to pay $1 for your wheel. I'm willing to pay you $2 now. Just make the wheel. Give it to me before you give it to somebody else. So that is like the classic definition of a supply side recession.
There's another piece to that too, Chamath.
And sorry, just to finish the point. And the Fed basically confirmed this in the minutes that they just released today. Jason, can you just read the quote that you had in the notes?
Well, the one up top, a significant risk that elevated inflation should become entrenched if the public begins to question their resolve.
I think the point is that, we were kind of in a supply side recession, and now by raising rates to some crazy amount, the end of which we're still not sure about, may actually then trigger the demand destruction to have a demand side recession. And so I don't know that we've lived in a modern point in time where both things have been true. Right? There's been a principle of macroeconomics that everybody's always kind of debating, is this a supply side issue? Is it a demand side issue? We know that in COVID, it was a supply side issue. We took all the supply out of the market. And now we're trying to figure out when we exhaust, all of the money we've given people and we destroy demand and take the incentives for demand to go away, right? Consumer confidence is now starting to turn. What happens then? Well, we're going to figure that out in the next 6 or 9 months. But the thing is, you have both that are true. It's not as if the supply side of the economy has been fixed. It's not as if everybody is running at 100% capacity. It's not as if all the supply chain issues have been worked out.
Yep.
So I don't know. I just think it's a very complicated situation.
An amazing statistic today from one of the major brokers. They said that by the end of the year, they're expecting 30 million square feet of office vacancy.
30 million?
In San Francisco by the end of the year.
San Francisco's tiny, by the way.
Because of subleases and then tenants rolling off. So the first thing I did is I tried to Google what's the total square footage in San Francisco, and I think it's about 75 million of office space.
Oh my Lord.
So you're talking about 40% vacancy by the end of the year. I've never heard of such a thing. 40%.
Let's be clear, San Francisco's fairly unique and a bit of an outlier in the circumstance because so much of it was, tech heavy and so much of it went remote.
Yeah.
And the city collapsed and it all got crime. But generally that's not the case. I mean, New York is apparently still pretty stable, right? And Miami's obviously doing well. LA, Austin.
But here's the piece of it that people aren't really thinking about, which is the only reason it's stable is because tenants sign up for long-term leases. And this is why it turns out that WeWork was a pretty bad business model, is because if all your leases are month to month and you hit a recession, your revenue gets whammied. This is why landlords like long-term leases with credit-worthy tenants. They sign 7 years, 10 years, and so on.
And letters of credit, right?
Right.
Put a year down.
So what that means, though, is that as these tenants start to their leases roll over the next few years, they don't need as much space because they've either gone remote or they're like hybrid now. And so they're thinking of their office less as a headquarters, which everyone needs to go to, and more as like a co-working space that their employees occasionally go to. So they're all reducing their footprints. This is why San Francisco keeps increasing its vacancy, is that as more and more of these leases roll, there's just no need, they don't need as much space. So they're also downsizing. Now here's the problem is that these buildings have debt on them, right? And that debt has what's called a debt service coverage ratio, DSCR. And basically you as a building owner become in default on your debt covenants if your revenue from the building drops below a certain number. And here's the problem. All these new leases that get signed, to the extent there are any, they're going to be at a fraction of what the old leases were, because this vacancy is going to create a massively low market clearing price.
Am I right to understand that they're not allowed to sign those leases because they're under it? So can the landlord take it as better than nothing, or do they are not allowed to take it?
It's not that. It's just that the market clearing price is going to be so much lower than their old leases that when they then look at the revenue from the building, and by the way, that building's going to have a lot of vacancy on it now, they're just not going to be able to hit their debt service coverage ratio. So they will be in default. What that means is, I don't understand how in a place like downtown San Francisco, half the buildings don't end up getting owned by the banks. Well, the banks don't want to own all these buildings, so it's going to be a fire sale. But I don't know who the buyers are going to be. I mean,
they just have to convert it, right? I mean, that's the only thing. They got to convert these to residential because we have a housing crisis still. That's the only way out. That takes years and years.
That takes years and years. And that's a repositioning play. First, you need the cooperation of the city government, which isn't going to happen. Then you need developers to come in and have the capital to basically make all those changes. Again, it takes a long time, but think about the systemic risk from that, right? If you know that a huge chunk of the real estate is the commercial real estate in downtown San Francisco, which used to be blue chip. I mean, the most blue chip, right?
Yes.
Who are those financial institutions who own those assets? Because they are now toxic assets, and they will be revealed to be toxic assets as soon as the leases roll. Well, and then there are debt funds and banks as well, right? And so what are the cascading effects when those shoes start to drop?
Everybody else is going to roll up their sleeves and buckle down, but he has no intention of doing it. I think people are roughly the same way. And I think their behavior is, if things are going to get hard, I'll deal with it in the future. But right now I have money in my pocket. And, if you look at airlines and how many people are trying to travel, if you just look at like the cost of a hotel room, if you look at what's happening this summer, it does not seem like people are slowing down or tapping the brakes in any way.
Yeah.
This is where I get concerned about credit, because it's not coming from wage gains. The increased cost is there. The increased income is not. And, we're seeing continued month after month increases in consumer credit balances. And that, I think, this was the point I made a few episodes ago, was I don't think people are going to slow down how they're living and how they're spending.
It's exactly what the data is showing.
There's an inertia. There's a lifestyle
I don't know
inertia.
about that. I don't know.
Well, I just think after 2 years of a lockdown, I do think that people are anxious to reestablish some amount of normalcy. And this is really the first summer where everybody writ large can be out and do the things that they were planning on doing.
Last year was the head fake summer, yeah.
Last year was a little bit of a head fake. And look, you have 2 years of pent up plans of,
Weddings.
50th anniversaries and weddings and all of this stuff that's happening. Yeah. And so I think people are really spending money.
And if you look at it, the consumer is holding up amazingly. It's got to be some combination of jobs, home prices, and this inflation.
But this is why there has not been a downtick in demand. I don't know why everybody thinks that there's been a downtick in demand.
There was an article today. It's not showing up in the numbers yet.
No, I think it is.
Then it's just anecdotal and guessing.
It's very subtle. Okay, sure, it is. There is a subtle.
I actually disagree with you guys. I actually think that the economy is pivoting on a dime here, and it's starting to show up subtly in the numbers. Here's some other data points. Consumer sentiment, biggest drop in consumer sentiment in 40 years. That was in the last month. Right track, wrong track polling, only 10% of the country thinks we're on the right track. If you poll people and ask, are we in a recession? Something like close to 60% of the country already thinks we're in a recession. There's a slight political tint to that. More Republicans than Democrats think we're in a recession. However, even roughly half of Democrats think we're in a recession. So I think
those are all feelings, not behavior, though, Sachs. We're looking at the data, not the sentiment.
I think the behavior will catch up with the sentiment. I think the behavior is pivoting.
Yeah.
It's just that I think you have to dig beneath the surface, and you have to look at things like retail sales, things like that.
I'm not sure, David, if you look back on all the number of times consumer sentiment has dipped, that the correlation to spending patterns is so uniformly predictive as we think. I mean, I think that there's a slight positive correlation, I remember, but I don't think it's like, 0.75, 0.8, 1. It's not that. So there's this weird preference falsification that happens when you get asked, what do you think is going to happen versus then what do you do? Yeah. And I think a lot of consumers, that's why they have, we know the data in America, like less than a month of savings or whatever those numbers are. Despite all of the sentiment analysis and all of this stuff, you would think that there'd be behavior change, but mostly people kind of just live in the moment. And, that's partly because they don't have the structural support to save or other things. But the reality is that most folks, from what they say to what they behave, there is a gap.
What did you guys think of the analysis from the experts of the All In podcast? Do you agree with Chamath regarding consumer sentiment? Comment your thoughts in the comments section down below. If you enjoyed this video, please like and subscribe. And we'll see you on the next one.